All right, we are seeing futures lower after a jobs report that missed the estimates, at least in terms of economists surveyed. We were looking for 160,000 in our survey here at Bloomberg. The Wall Street Journal was looking for 170,000 in terms of their survey, and the number came in at 151. So as a result, although you've seen some up and down, we are now down in terms of futures. S&P futures off 1/3%. NASDAQ futures down about 1/4%. You hear the opening bell on the New York Stock Exchange and on the NASDAQ. I believe it's a sea of ladies on both marketplaces because tomorrow is International Women's Day. It's interesting to see at the New York Stock Exchange. I worked down there when there were like 900 guys and 2 women. So they've really drastically changed that ratio. At the NASDAQ market site, normally, you know, there are only people there to ring the bells. But in terms of the major indexes and the live cash trade, we have a lady for you to check on those as well. Katie, happy International Women's Day.
Happy International Women's Day to you too, Matt Miller. The market's not exactly celebrating right now. The S&P 500 down 0.3%. That pop we got after the numbers at 8:30, a distant memory right now. And remember 6,000 on the S&P 500? We're obviously getting lower and lower when it comes to these levels. Same story, too, if you take a look at the NASDAQ 100, down about 0.1%, even though we did get some relief when it comes to the chip makers. I'll get to that in just a moment. But you take a look at the small caps as well, really getting caught up in this sell-off on the Russell 2000. This is your worst performer year to date on the big index level. The Russell 2000 down another 0.2% today. Let's get specific here and look under the hood. We're keeping a close eye on the Magnificent 7 index following the jobs report, down about another 0.2%. But I wanted to take a look at Broadcom as well. You can see it's higher by about 3.6%. It reported earnings earlier, basically putting some life into that belief that AI spending, that boom, it remains strong. This gain, though, pre-market had been 8% at one point, Shanali, so even the enthusiasm over the specifics of Broadcom's report fading now in this market.
This is a market with low excitement levels. But over here, got another down era story. HPE down bigly. It says that profit in the coming year would be hurt by tariffs, weak margins, and on server sales. And the company is planning 3,000 job cuts. We've been talking about it. Kind of a brutal day over here, but more and more companies talking about that tariff threat, Matt.
All right, and we're also watching Gap pretty closely today. The turnaround playbook appears to be working as sales remain strong across most of its brand, up 7% at the main brand, the Gap, up 3% at Old Navy. Old Navy up 3%, which is, I believe, its biggest moneymaker in terms of revenue. And then Athleta down 2%, but Shanali's going to do something about that in this quarter. Let's turn back to the markets here because we are very close to correction territory on the NASDAQ 100 index. Right now looking at 20,032, and if we get to 19,958, that would be a 10% drop from the highs that we saw on February 19th. Bloomberg Technology Co.'s Caroline Hyde joins us now. So Caroline, we've seen already, you know, a 9.5% drop, more than that, a substantial decline, and we're close to a correction. What are you hearing on your show, Bloomberg Technology?
Well, the hope was that Broadcom might steady some of that anxiety. And look, it is trading higher, and on a points perspective, it's the biggest contributor to the upside. But a lot of this may be down to short covering. That's why we saw some significant moves in the pre-market and indeed post-market yesterday after the bell. This is a company that was sold off more than $200 billion worth in terms of market capitalization only this year. And we were steadied in terms of seeing 19% growth in the fiscal quarter about to come. We're seeing significant, more than 70% growth in AI in particular. And this is where the anxiety dialed back a little bit. Are we just meant to be selling generative AI winners at the moment because we're not going to need as much compute because you've got all of these fantastical models coming out of China that seem to need less data and less compute to still give us incredibly powerful generative AI models? Broadcom managed to steady nerves, showing that hyperscaler demand is still there, showing that networking is necessary, and indeed that people still want to design their own chips. But it's not enough to dial back some of the anxieties more broadly as we head into a weekend where people don't want to be long tech.
That feels like the story of this market right now. It's just not enough. Of course, maybe that relief that we got on the jobs print, it wasn't good enough. What we heard from Broadcom, those stabilization of those fears, it's just not good enough. And I want to talk about how the the trade picture fits into the big tech story. We had this conversation with Gina Martin Adams earlier in the week, and I just keep thinking about it, that you don't necessarily think of big tech when you're considering the impact of tariffs. You probably think of more physical goods that, yes, exactly, that we see and touch and feel. But she made the point that you think about the cost of goods sold for a lot of these big tech companies, a lot of that is outside the U.S.
Yeah, and that's why we want to be hearing from Antonio Neri on the show a little bit later. HPE, what are the cost of goods implications of tariffing China? What is it that we're going to hear from some of the big tech leaders who are going to Washington next week, among them IBM, among them Hewlett-Packard, HP? What are they going to say in terms of ultimately China exposure? For me, it's all about NVIDIA as well. Look, this is a company that is significantly impacted by potential tariffs and restrictions on selling into China in the future.
I am very much looking for your readout after that meeting on Monday, but I'm also looking for your readout from today because the White House is holding a major crypto summit. Bitcoin, while there was a lot of excitement about it, it's another asset that lost a lot of its bumps since the election.
Yeah.
But you have hundreds, maybe, of investors down in Washington now trying to get a readout. And you have David Sachs on AI and crypto.
He's the crypto and AI czar, and he's coming on the show before that 1:30 p.m. New York time meeting over at the White House, which, taking a step back, isn't that extraordinary that they're actually going to meet the president, these crypto executives among them? You'll see some of the CEOs of some of the largest exchanges going, turn around in the vibes around crypto, and the executive order front run it. We saw it yesterday saying, yes, you're getting your strategic reserve when it comes to Bitcoin. Yes, you're going to get a stockpile of other assets, but basically maybe there were people out there thinking that they'd be able to buy more Bitcoin. That's not happening. They're not going to sell the Bitcoin that US government already holds, that they've taken from forfeitures. That takes away a lot of the anxiety that suddenly Silk Road confiscation is suddenly going to end up in the market, but not enough to perhaps support the run-up that we'd seen in Bitcoin and the hopes that had happened. But I can't wait to speak to David Sachs really about what he thinks is going to come from the crypto audit, what actually they hold, and then where next for an AI executive order. We need to know how they're going to keep on building US exceptionalism there.
That's a good point. He's crypto and AI czar, right?
Heady mix.
Yeah, big job there.
So many South Africans.
Yeah, that's also a thing as well. Really looking forward to that interview with Caroline Hyde coming up at 11 a.m. on Bloomberg Technology, and it comes as Bitcoin below $90,000. I remember when we were at 110, but in any case,
Dude, I remember when we were at 600.
Yeah, well, you know, you're.
And by the way,
you're one of the OGs.
That was many, many years ago, Matt.
That was, but on election day we were still trading at below 70,000.
Fair enough.
So since the election, we're still up about 20 grand on the Bitcoin.
Can I tell you
price.
something? For a strategic reserve, I don't know how that benefits everyone who doesn't hold Bitcoin.
I have a lot of questions about the strategic reserve. I will leave it there. Let's get back to these equity markets because we are in sell-off mode. So let's get to Sanctuary Wealth Chief Investment Strategist Marianne Bartel is joining us now on this Jobs Day. And Marianne, we usually look to you as sort of a bullish voice amid the noise. But you think about the concerns that we're dealing with right now when it comes to inflation, when it comes to growth, when it comes to the uncertainty over the trade picture and maybe the corporate America engine slowing just a bit here. What's your read on this situation?
So this is where I rely on the technicals. What are the technicals really saying about the market? And I would argue we are in a correction, even though we haven't quite hit that 10% level. I do think we're in a correction for the markets. And I don't have a signal that we've reached a bottom yet. Not going to hold. What's really surprised me is that the put to call ratio has not spiked. So that's going to be one of the things that I'm looking for is for a spike in that put to call ratio and maybe a climactic kind of up move in the VIX index. VIX is already elevated, but you probably need that to spike up a little bit more.
Well, I'm glad you brought up the 200-day moving average, and we have a great chart to show it.
It's beautiful.
It is beautiful. It's got a line on it, and it's got the S&P 500. It's coming up, but we were doing some really light, there it is, novice worth technical analysis yesterday. I know that you spent many, many years in technical analysis. So you mentioned that you think that the S&P 500 could break below the 200-day moving average. I tweeted this chart yesterday. I got a lot of questions to the effect of, do I buy the dip when we get below the 200-day moving average? I mean, if we do break below it, as you think we will, how big is that air pocket that it could create?
think we're in a bear market. I think that's probably what we're all trying to wrestle with. Are we going into a bear market? I don't think we're going into a bear market. I just think this uncertainty has created a cloud over investors, and they're kind of frozen. And I can also understand if some business leaders are holding back on some business decisions until they have more clarity on where we stand on the tariffs. So the air pocket, I don't think is a bear market. I think it's a correction. I'm even a buyer here. I have been a buyer. Again, we're never going to know the exact bottom to buy necessarily, but I think between this level that we're at the 200-day moving average and around 5,400 in that range is going to be the really good buy zone, though, if I was really looking to time it.
All right, I just want to point out that we are looking at stocks that are edging higher here. We were lower at the open, and now the S&P 500 is putting up a gain of 0.1%, so not groundbreaking news. But look, I want to get to you on Bitcoin, Marianne, because not only, well, first of all, you own Bitcoin, we know, because we've asked you about it in the past. But typically, it hasn't been an asset with a lot of fundamental analysis potential. Now you've got, this sovereign crypto fund idea. What do you think that changes in terms of the path of the price, and also what's your take on the technicals of Bitcoin?
So what I like about the Trump administration talking about creating a crypto reserve, I think that just gives more confidence and more credence to the asset class, that this is an asset class that's not going away. I think that's really important. Bitcoin has been correcting. In fact, most asset classes have been in a corrective phase. So I still think Bitcoin is in a correction, but is in a long-term uptrend. So the worst downside I can get is somewhere around 75,000. I think we got down as low as 78,000 on this pullback. So between 90 and 75, I think we're going to find a footing. And I'm still maintaining my target this year of 113 to 150 on Bitcoin.
Marianne Bartels of Sanctuary Wealth, we thank you so very much for joining us. Happy Friday to you. It has been a tough week in these markets. But coming up, we're going to look at the retail sector because the turnaround playbook at Gap is working. I hear people might be buying some Athleta next. I hear that that's the one part we're still looking at. We like our yoga pants here on this set. We're going to give you details on all that next. This is Bloomberg.
Is still strong. The CEO of Lumen Technologies will weigh in just a bit, but let's get to these markets right now. A little bit of a turnaround underway on the S&P 500 on pretty hefty volume. You can see we're back to unchanged. We had big pre-market gains, big being relatively speaking. Then we were down about 0.2%. Now we're back to unchanged, really sitting on the knife's edge here of the 200-day moving average for the S&P 500. We'll watch that, as well as the NASDAQ 100 with big tech really in focus here, currently higher by by about 0.1%. Then you take a look at the bond market. That sell-off easing just a little bit. You can see now that yields are lower by 3 or 4 basis points or so on, I think they're higher though. In any case, you can see that the 10-year yield. Yeah, I think we were at 421 earlier, but
we were when the show kicked off.
Yeah.
Nonetheless, that arrow is pointing down.
It certainly is.
And the color is green, which means investors are buying bonds.
We're going to look into that, but the point that you need to know is that your 10-year benchmark treasury yield is at 4.24%, Matt Miller.
All right, a little bit of confusion this morning. We heard from, on that note, White House National Economic Council Director Kevin Hassett last hour. He shared this outlook.
There are lots and lots of different things that we care a heck of a lot about. For the drug war, the thing we care about is reduction in deaths of fentanyl. In the economy, what we want to do is see a creation of manufacturing jobs, especially auto jobs. And we want to see a successful tax bill. And I think that all of that is going to give us the 3 or 4% growth that we're all hoping for.
Joining us now is Tiffany Wilding, PIMCO economist, and Tiffany, you know, he's talking about the things that they're watching, which I thought was interesting and legit. The confusion comes from a couple of other statements he made to John Ferro in that interview. He sees a massive amount of onshoring already. I wonder if you see that as well. And he said he sees quite a bit of clarity in Trump policies. Is that fair?
Well, you know, I think the overall what we would say is the Trump administration is trying to implement what are pretty big policy pivots. We see the focus here is reducing the trade deficit, reducing the fiscal deficit, and reversing what economists call labor share, the hollowing out of the middle class that's happened over several decades. These things are structural shifts, and trying to reverse them, you know, over a short time or a cyclical horizon, you know, is just going to be tough. And it's going to face political, economic, market constraints, you know, and it could potentially result in some disruption. So, you know, I think it is clear what they're trying to do, you know, but whether they can do that, you know, amid the constraints that we have in the U.S. economy, they have small margins in Congress, by the way, you know, and other constraints in other economies. I think implementation is what is more uncertain and going to be difficult.
Well, also, if you think about what's still uncertain, too, they're the DOGE-related job cuts and other weaknesses in the economy that are still obviously not seen in the report that we saw today. How do you map out what to expect next?
Yeah, no, and I think that's a really great point, which is that even if some of these, I guess, DOGE-related moves are not codified in law to actually reduce government spending and to affect the deficit, you know, they are going to affect economic outcomes in the near term. We have seen, you know, what surveys are starting to estimate is 50 to 60,000 people, you know, that have lost their jobs across federal government and contract workers. You know, that should show up in the labor market surveys. And so, you know, I think we're setting up here for potentially, you know, more of that disruption to be seen in the March survey. You know, and if you take a step back, you know, one of the things that we think has really driven labor markets or has helped labor markets, maintain very strong momentum over the last couple of years has been immigration. You know, the massive immigration flows that we've seen. So as that, stops, that should also really reduce labor market momentum. And so I think we could start to see that over the course of this year, you know, whether that really creates, recessionary views of recessionary risks, you know, that then compound. We're already starting to see sentiment drop, I think is the key question. And that'll be the key question for the Fed, outside of the inflation risks.
Well, tying those two things together, I mean, we also heard from Kevin Hassett speaking to reporters just a few moments ago, saying that we will see a bigger hit on government employment in the next few reports. So if we see big weakness there, we know what the administration will point to, but jobs are still jobs, still has an impact on the labor market. So I want to hear more directly your thoughts on how the Fed handles this, because if the labor market is weakening, they have to respond.
Yeah, well, so I think like one thing that's a little bit of a complicating factor is that federal government employment has actually been more or less flat over the course of the last several number of years. The increase in employment has really come from contract workers, and there is a lot less data around actually how many contract workers or folks have been employed as a result of these government contracts. There's various ways to estimate this. We think that's the potential for a bigger impact. So it'll look like more economic weakness potentially. It'll be difficult to understand, what is related to those contract worker separations versus just what is broader economic weakness. And I should say on that, we are seeing sentiment deteriorate. The equity market is a very important sentiment indicator. CEOs obviously look at their stock price when they're thinking about investment and hiring decisions. And I think the real risk here is that you have, sentiment that deteriorates that results in a more meaningful for slowing. And I think the Fed would definitely be very attuned to that.
What do you think about, the goal of this administration, as we hear from Scott Bessent, is to lower yields on the long end. And at least so far, they've done quite well. Regardless of why we see that. And then, obviously, they want the Fed to be cutting rates. Now we expect more Fed rate cuts as well. So what are your expectations for the Fed through the year end and for the 10-year as well?
Yeah, well, I think ultimately the Fed, I think overall these policies present a very tricky environment, for the Fed and for central banks because, although on the one hand, they will contribute to slower growth, slower labor market momentum. I think they potentially increase downside risks, at least in the near term. But on the other hand, it's not necessarily obvious that inflation is really going to be dampened by that, right? You have potential one-off adjustments related to tariffs that will, that will support inflation, and then some of the slowing in immigration, because immigration impacts both supply and demand, not as obvious that will have a meaningful, kind of dampening effect on inflation either. So the Fed will have to manage that. Ultimately, I think if downside risks to the economy are greater than what the Fed perceives as upside risk to inflation expectations, they will react. And I think the near-term risk, at least, is that you do get more cuts being priced in, for the Fed. Even if later this year the focus turns to tax cuts, the potential, the things to deregulate, within the finance industry and what have you. I think near term, the focus is more on the potential for some economic disruption.
Tiffany, we thank you for joining us this morning. Tiffany Wilding of PIMCO, and of course, a very complicated jobs market. A lot of concerns still out there about inflation, but first, some of those are hitting stocks right now, actually. Costco is among retailers that's now taking a cautious outlook as U.S. consumer confidence declines. The dip in Costco, guys, it's interesting. It's actually the biggest drop we've seen since March of last year, and we know that they're certainly not the only one feeling this kind of a pain.
Yeah, and it's interesting. I mean, I guess it theoretically is a retailer, but it's a different type of retailer than a Gap, for example, which is having a great day. But broad brushstrokes, the retail sector has been in an interesting place. Let's also talk about Intuitive Machines.
I just want to point out,
yeah.
You're right in that it's a different kind of retailer. They missed earnings expectations, but BJ's, which is a big competitor to Costco, really knocked it out of the park. So BJ's had a huge surge in its stock as it did well on revenue and earnings. But the interesting thing to me is among all these retailers, you're seeing these notes that they're exposed to Chinese imports and asking these importers to cut prices because they're worried about tariffs.
Yeah, specifically that was a story about Walmart yesterday. That was a big theme, but there's a lot of nuances here, a lot of idiosyncratic stories when it comes to all these earnings reports, so have to read really closely here. Let's talk about Intuitive Machines. I had to look up what this company is, but apparently it just got in touch with its moon lander, which touched down 250 meters from its intended target. I believe that precision is the name of the game when you're sending things to space. So as you might expect, the shares are down over 20%.
Especially here, because I was listening to this landing live on Balance of Power radio yesterday.
Wow, do you listen to that a lot?
I listen to it every day, as you know. And it's just interesting to hear a moon landing. It's like a sports event, but there were so many different voices. I got a ton of data from that show. So Joe and the team did a fantastic job. The problem with missing the mark with this lander is that they need to recharge in order for the machines to work and to get the data and to send it back to Earth. But because of where they landed, they can't recharge the satellite.
You know what else has been sort of kind of a little bit going to the moon?
Oh no. Oh no.
Is
that what you're doing?
Is that bad? Is that a bad pivot? Walgreens, because it's planning to go private in a deal with Sycamore. It's up 7%. It might not feel like a lot. It's a stock that's up 22% this year. It's had years of declines. This has just been a stunning story. Finally, the announcement this morning, this has been kind of out there in drips and drabs. We broke this just days ago. They will be purchased for $10 billion. And remember, the reason that this is an interesting ongoing story is there's going to be a lot of really fascinating financing deals around this too. So it is a story that has Wall Street on high alert.
Well, just quickly, Sycamore, the details of this, they will pay $11.45 a share in cash for Walgreens. You take a look at where the shares are trading right now, just about at $11.40. Not much of a premium, of course. They were about 8% below yesterday when this deal was announced. So we'll see. But you take a look at that 5-year chart. It has been an ugly, rocky 5 years for Walgreens. And now it'll be a private company, theoretically, if this deal does close in the fourth quarter.
You know, it's just one company where private equity is taking the lead. Private credit is actually funding the $4.5 billion debt packaging. And the reason that's interesting is because bond market volatility kind of sucks right now. It has been elevated at the highest levels of the year. And so public debt markets, it's tough right now. So yes, going private, that's the move for the moment.
All right, if you are looking to refinance your mortgage.
Yeah, more about bonds, but
or
not
if
for
you're
consumers.
looking to get a mortgage at a lower rate. There's good news in these markets. Those rates continue to fall. We're going to get a read on the real estate industry with Bess Friedman, Brown Harris Stevens CEO, next. This is Bloomberg. getting out of high interest. Look at what's making headlines around the world. President Trump says he is strongly considering large-scale banking sanctions and tariffs on Russia until a ceasefire and final peace agreement is reached. In a post on Truth Social, the president wrote, "To Russia and Ukraine, get to the table right now before it is too late." And he added, "Thank you," which was very polite. NASDAQ is planning to offer 24-hour trading on its exchange. It's the latest venue trying to capitalize on growing demand for U.S. stocks. It plans to enable the extended trading 5 days a week and expects to start round-the-clock trading in the second half of next year, pending regulatory approval. It follows moves by the NYSE, which filed its own application to offer extended trading earlier. And SpaceX's mammoth Starship spun wildly out of control and broke apart during its 8th test flight. It's another setback for Elon Musk's company less than 2 months after its last mission exploded. The rocket sent debris shooting through the sky. SpaceX lost communication with it about 9 minutes after the launch. Musk said the next ship will be ready in 4 to 6 weeks, calling the incident a minor setback. Janelle?
And Matt, we've been watching this really closely because we talk about that bond market, but for the 7th straight week now, you've seen that decline in the 10-year, and even more so for consumers. The mortgage rate has fallen. The average rate for the 30-year loans was down to 6.63%. Still feels high, but it does prove some relief for house hunters that have been sitting with that 7% mark roughly. Let's get a read now on the housing market with Bess Friedman, Brown Harris Stevens CEO. Brown Harris Stevens is a luxury real estate brokerage based in the New York metro area and South Florida. On one hand, nice to see mortgage rates declining. On the other hand, we're seeing weakening economic data. If you're feeling broke right now, then why you wouldn't go out and buy a house, even if you see rates declining, would you?
No, and I think that's a great point, that people are feeling stressed. Prices are still very high, and even though rates have ticked down a little bit, people are still not able to afford homes. And the inventory is still very tight in certain areas. So I think, yes, this is a little bit of a positive step, but you still have that lock-in effect where sellers don't want to list and sell their homes because they have a 2% and 3%, and that still remains a challenge for our housing market.
So what is the level that we need to get to roughly where things start to unlock a little bit? 2 to 3%, that would be great. It feels like we're a long way away from there specifically, but where could things...
I would refinance at 2%. That's insane.
I think we don't see it again.
That's what I'm saying. I would love to see 2%. I don't know if we will anytime soon, but where do things start to move a little bit?
I mean, studies have shown that around 5% more people will get into the market. Sellers will be more inclined to list and sell. So I think that would help. But the more we start to move down, the better the market will move. We'll have more fluidness. But right now, the housing market has been very confusing. Even though January was a good month overall, it's slow and steady. And the chaos or the turbulence that we see in the overall economy with tariffs and all the things that we read about creates strain and uncertainty, which is not good for any market. So, we're waiting and seeing what happens.
That's what I'm not sure if I'm right in this, but I always think of you as doing high end. Maybe that's just because of you. But what do you see in terms of the different markets, right? I mean, lower price stuff, I imagine, is still difficult, but are you having trouble selling $5, $10, $15 million properties?
It's interesting. We do everything, including rentals of studios. We do it all, but the high end has been very good. We've done a lot of business. Remember that the bonuses on Wall Street were 20% higher. People have a lot of money, so the high end is doing well. The challenge overall in the national housing market is really that people can't afford their first-time homes. That's, the first-time buyer is the one that's challenged today more than ever. And so I think we're going to need to see more inventory movement in rates before we see improvement there. But this is a discretionary market. Let's be clear. New York City is a discretionary market. If you own in New York, it's a choice. If you own in Palm Beach, it's a choice. Most Americans don't have that choice.
What do you see as fallout from, and I know you're not in the Carolinas necessarily heavily or in Los Angeles, but those two disasters have displaced so many people. Do you see fallout in New York or Florida?
I think that people are making decisions. Some people are deciding that maybe it doesn't make sense with the price of insurance and to rebuild and do all the things. You know, there's ecological issues that people understand when they move to places like that, and some people will make moves based on that, but some people will say, you know what, I know what the risks are, I'm going to stay here, I'm committed to it because of the community and what it offers. So yes, I think you're going to see some movement, just like with COVID, which served as a catalyst for people to look at other places.
Well, one of those places, of course, was Florida, specifically South Florida, a market you're involved in as well. Was that just a COVID trend? I mean, you hear mixed reports that maybe that Florida boom is starting to slow a little bit. I mean, things are expensive in Florida. What are you seeing there specifically?
I mean, it's unfortunate, but we're still seeing some migration of New Yorkers moving to Florida. And I think because of taxes and other things, people are going to continue to do so. So I think that's a challenge that New York has to reckon with. And we have to create places, more homes for people here, make it more affordable.
What's the Trump effect? I was down there a couple weeks ago. I'll be down there next week again. I think even the week after too. It's a lot of Florida time
so
for me.
much.
A lot of interviews down there. A lot of people are headed down there.
A lot of conferences.
A lot of conferences. A lot of businesses have moved to Palm Beach, for example.
But how much does the president's activity there draw more people down there? I've been hearing tech executives starting to move, people coming out of San Francisco now. Are you seeing that?
I think so. I think, you know, look, people want to be close to power. I mean, it's a human thing. People do want to be close, and they're drawn to that, and it creates a lot of, you know, attention, and restaurants are full, and people are there. I mean, there's a lot of New Yorkers in Palm Beach, and, you know, the people that have lived there forever, for generations, are a little frustrated with now all of a sudden they hear, you know, cars are honking their horns. You know, it's a little bit more, New Yorkers bring a lot of noise with them. So we know this. It's good noise, but sometimes people just want quiet. They want to play tennis, they want to swim, golf, they don't want all the chaos.
That's why they have Naples. You know? All right, Bess, great having you,
Thank you guys.
On the program. Thank you so much for joining us. Hope we can talk to you again soon. Bess Friedman there of Brown Harris Stevens. Coming up, would you rather live in Dallas or in Salt Lake City? That's a question some Goldman managers have to answer because they can't stay here. We'll have details on that story next. This is Bloomberg.
Now, Goldman is giving managers a choice: move to Dallas or Salt Lake City and leave New York behind. The push to locations outside the main hubs aims to drive down costs and tap a pipeline of talent emerging in those regions. The bank's Dallas hub has already grown into one of the largest operations in the world. Now, some managers are getting this choice: move or leave, right? And the name of the project, guys, I think is fascinating: Project Voyage. So there is a longer effort, a bigger effort, not just here, but also in London as well. You know, some people like the move to Dallas. Do people like the move to Salt Lake City as much? I don't know.
Absolutely. I would absolutely go to Salt Lake City. We were talking about it early.
Yes.
You get cowboy hats and big trucks if you move to Dallas. You also get that if you move to Utah. So that's for...
Is there a Kimosabe in Salt Lake City?
We should open
There probably is, and probably in Park City. You're so close to the best skiing really in the country.
Yeah,
that I would go there. The funny thing to me is, the ironic thing is that when I was a kid, if you worked at Goldman Sachs and had to go to Dallas, that was like going to Siberia. That was literal punishment.
Equities in Dallas.
Yes, exactly, from Liar's Poker.
Yeah, now you have a lot of exchanges also moving to Dallas. The Dallas or the Texas Stock Exchange would like to open as well. Really quickly, we do have some breaking news, and that is that Donald Trump is now scheduled to deliver marks at 11 a.m. Eastern. That is according to an email statement from the White House. So stay tuned. This is Bloomberg. All right, let's get a check on these markets. We've been wiggling around a lot, and at least for right now, the S&P 500 a hair lower, down about 0.1%. We've been up, we've been down in the wake of that non-farm payrolls print that we got at 8:30 this morning. A slight disappointment there, but maybe not so bad that we're seeing just another day of sell-off, because boy, it has been a brutal week. The NASDAQ 100 down a little bit more. The 10-year Treasury yield camped out at 4.25%. But let's focus in on some single stocks and the tech sector and AI broadly, because AI, when it comes to Broadcom extending gains after the chip supplier's earnings reassured investors that AI spending remains on track. You can see shares up almost 3%. We were certainly higher than that pre-market. But another AI name we're keeping an eye on right now is Lumen Technologies. And I'm pleased to say that we're joined by Kate Johnson. She is the company's CEO and president. It's great to speak with you again, Kate. The last time we spoke in late October, you had just signed a deal with Amazon to basically build links between Amazon Web Services main data centers and smaller outposts near big cities. You have similar deals with the likes of Meta and Microsoft as well. As I understand it, these are long-term leases that is happening here. So when will we start to see that leasing revenue on these new routes start to show up in your earnings?
Yeah, it's a great question. We're in, kind of the early phases of the evolution of the AI marketplace. Phase one being hyperscalers, cloud companies, big tech thinking, okay, how are we going to serve up and train these AI models? And they're connecting their data centers. We've won a lot of that business. We're excited. We hope to win a lot more. And I think the next phase is when enterprises start to use those models. So from the perspective of us building out the backbone of the AI economy, it's a couple of years before the revenue actually starts to come in at steady state. But as we see, the enterprises are asking to upgrade their networks as well. Going from 1 and 10 gig to 100 and 400 gig, it's a race for bandwidth, and Lumen's got it. So we have a couple of different phases that we're enjoying.
I just want to point out, completely separate from this conversation, we are seeing a drop in the NASDAQ 100 right now, trading at 19,950. Does that leave us in correction territory?
I believe we're officially there.
So that's a bigger than 10% drop from the highs on February 19th. Not terribly important, just a big round 10% drop number that I thought I would share with viewers. Now I want to get back to the Lumen conversation. You've seen a lot of volatility in your stock as well, Kate. We were looking at a long-term chart, and you just absolutely crushed it in 2024. I think tripling the value of your company. It's been a drop in 2025 since those highs as well. Does that change the way you do business? I mean, do you look at the stock over, months or years, and do you need that currency to do your business, or was that, a capital raise when you sold the shares and now you're just barreling forward with what you do?
Hey, look, we're super proud of the progress that we've made with respect to the stock price. 200% growth year over year today is something to be proud of. But that's not what we think about. We're obsessed with what our customers need, and we're delivering it day after day, and we're designing the future of networking, and that's how we're ingratiating ourselves to them. That will accrue to shareholders, that will accrue to employees, but it's all about customers. That's our mindset every single day.
Speaking of customers, if you look at what is kind of going on in the broader atmosphere here in recent weeks, there has been, let's say, a relatively negative tone around future spending plans, about future prospects. You really see it in the Philadelphia Semiconductor Index more than anywhere else, perhaps. How do you look at what's happening amid kind of the turn in attitude with investors when it comes to the hyperscalers and even the chip companies, given the broader environment right now?
Look, I think it's early days, and I think all of these companies are figuring out their strategy and their architectures for how they can thrive. And we think about it at the aggregate level. So there'll be puts and takes with every one of these players. We don't get wrapped around any one of those outcomes. We think about it at the aggregate level. And we are seeing a once-in-a-generation spike in demand for fiber networking services. It's a race for bandwidth, and Lumen's got it.
And of course, we've seen that in the deals that you've signed with some of these power players. I want to talk about, again, the specifics, the fundamentals of your business. And this gets back to my question on leasing revenue, because you take a look at your revenue growth, it's a little bit under pressure. Margins have been under pressure a little bit as well. When would you expect to return to growth when it comes to revenue, when it comes to margins expanding again?
So we've always talked about 3 phases to our recovery and turning this company around. And the first thing you need to think about is we are not looking for growth in the legacy world of telco. That's not, we're building the future for companies to thrive in a multi-cloud AI world. The first thing with the $8.5 billion of PCF deals that we did last year, we are now stable from a free cash flow perspective, and it's funding our transformation and giving us cash to pay down debt. We paid down $1.6 billion last year. We have more plans for tweaking the balance sheet on the horizon. We called on the last earnings call a pivot to EBITDA growth late 25, early 26. We're super excited about that progress as well. And then the third leg of the stool is revenue. And we have 2 growth levers that we're leaning into heavily. The first we talked about, building the backbone for the AI economy. That's going extremely well. We have a big head start. We're building the competitive moat every single day. A big part of that competitive moat is the digital platform we're building on top of it, our physical infrastructure, to make it easy for enterprises to consume networking services. It's differentiated. It gives them control over performance and bandwidth and security. It gives them a consumption model. And it gives Lumen shareholders digital revenue, which, as we know, is highly valuable. And both of those growth lever trajectories are going extremely well.
I just want to seize on your once-in-a-generation quote, Kate. I'm 51. I started working here in 1999. So I've seen a spike in demand for fiber twice, like this, around the internet bubble. At that time, companies were working on boosting revenue and weren't really bringing in a lot of free cash flow, weren't earning a profit. What do you see in terms of free cash flow and profit expectations at Lumen?
Look, we think about this fiber network asset, by the way, world-class, great coverage, unique routes, and we're winning business to build the backbone. And we think about it from 2 perspectives. One is capacity. We have a great partnership with Corning. It gives us 4 times capacity on existing routes. We're leaning into photonics innovation for greater fiber efficiency, and we're building new routes funded by customers. That's different than the old days where it was kind of, if you build it, they will come. We are doing this in partnership with customers. The second piece of it is driving utilization. The $8.5 billion of deals that we did with tech companies was leveraging once empty conduit. So we're doing something extraordinary right now. We're dramatically improving the capacity of our network, essentially expanding the internet at large. And we're materially improving utilization, which gets a return on these assets for shareholders that frankly is long overdue. We're super excited by the progress, and the future is very bright.
But net income, when are we going to see a positive number there?
So as you saw last quarter, we had great numbers and results, and I think we're thinking about it from the perspective of free cash flow done, EBITDA turnaround on the horizon, revenue after that. Stick with me.
Got it. Kate, thanks so much for joining us. Kate Johnson there of Lumen talking us through her business, and obviously we've seen just incredible growth in that stock over the last year. It's been a rough beginning of the year for tech stocks broadly, and for the NASDAQ, we're now seeing a correction.
It's interesting. You take a look at what is dragging the NASDAQ 100 to correction territory right now. The biggest loser in the NASDAQ 100 is Costco, down about 6.7%. A good reminder that the NASDAQ 100, you do have to look under the hood. It's not all tech, but we know that the Magnificent Seven in particular has been under pressure as well. We reached correction territory on that grouping a week or 2 ago, and now you have the broader index following as well.
Right. It's interesting because, to your point, it's not just the big tech names in that NASDAQ 100, but the tech names that are down, you're seeing it continue to have a bunch of pain. Marvell is that second biggest loser. We know that they had a tough earnings report earlier this week in terms of how it was received by investors. Lululemon is another big decliner in the index too, to your broader point. I'm also watching Netflix because I saw somebody make the point the other day that if you're worried about tariffs, if you're worried about economic growth, how sticky is Netflix's stock? I thought that was an interesting question because do you stop buying subscriptions to broader media companies if you are a little burned on the consumer side?
I mean, you have Netflix already. Everyone's bought.
Everyone's already bought it.
And you're not going to cancel it. But the quality, do you think the quality of their programming is just getting worse and worse?
No. Are you seeing?
Have you seen Zero Day?
I have not seen Zero Day. I don't know if those are the existential questions hanging over the market as a whole
Game?
right now. No,
the new
Squid
Kate
Game,
Hudson
I couldn't
show.
do it.
So
in any
good.
case, the story might turn around because coming up later this afternoon, we have Fed Chair Jay Powell. He's going to give his view on the U.S. economy. We'll bring it to you live at 12:30 p.m. Eastern. But before that, we're actually going to hear from Donald Trump, now scheduled to speak at 11 a.m. We don't have any specifics on his comments, but this
we're going to tune in
coming.
Anyway,
we're going to
sure.
tune in. This coming in the last couple of minutes. Stay tuned. All right, it's time now for our Wall Street Week conversation, and women's professional sports are growing quickly, with the WNBA's attendance almost doubling last year alone. David Weston spoke with Golden State Valkyries president Jess Smith about the investment in women's sports.
Since Caitlin Clark emerged as a budding superstar at the University of Iowa, women's basketball has skyrocketed, garnering the league more fans and opening up new markets.
We are the first expansion team since 2008. The last was Atlanta, and then following us, we have Portland and Toronto next year. So growth of WNBA has been a long time coming, and it's taken many years to get here. This building has actually always been here for the Golden State Warriors, and now it's our Valkyries Performance Center. So this is the area that, you know, the championships were won before Chase Center was built.
As in Steph Curry?
As in Steph Curry, yeah, small name, right? And now we've had an opportunity to make it our own.
Jess Smith was the head of revenue for the NWSL's Angels City Football Club, where she introduced new sponsorship models and broke records in attendance. She is now the president of the WNBA's Golden State Valkyries, the first expansion team in 17 years.
When you look back during COVID, the WNBA actually got together and played. They were the first league to do this. It was also a really key moment to where consumers were sitting at home on their couch looking for entertainment and tuning in and really taking note of these incredible athletes, really taking note of what they were standing for when it came to social justice. And there was an unlock that began to happen with consumers in women's sports. So as consumers began to unlock giving those ratings, began to unlock buying merchandise, buying tickets, and understanding that their dollars in time and interest was driving the growth of the W, media listened, right? Teams listened, leagues listened, and more investment began to come in, and those consumers have really, really rewarded everyone in that circle that is equated to the growth.
When we talk about growth, how do you measure it? What are the metrics you pay attention to?
There's two things. One is money and revenue, right? Are your revenue lines growing? Are you investing in the right way to make sure that those are growing exponentially? And two is fandom. How many people are coming into your ecosystem through purchases, but also followership on social media or TV ratings? And so if you're looking at both of those, the growth is very significant, but we have a close eye on both every single day.
As fast as women's professional sports are growing, they still lag behind their male counterparts, at least for the most part. Where the NBA playoffs averaged 4.5 million TV viewers last year, the WNBA had 1.1 million. 22.5 million fans attended NBA games in person, where the WNBA had 2.4 million. But the gap is closing. Viewership numbers were up 139% for the women last year, but down 12% for the men.
You have a foundation in both men's and women's sports. From your experience, what's different about the two?
That's a really good question. I don't know if I've been asked it that way before. I would say the assumptions of things. In women's sports, it's been assumed that when you create a product, well, you better not lose any money.
And that was David Weston speaking with Jess Smith. You can catch Wall Street Week tonight at 6 p.m. Eastern. But coming up on this program, we'll get back to these markets. The NASDAQ 100 falling officially into correction territory, down about 0.6%. The S&P 500 not too far behind, down about 7% or so from its peak, currently down about 0.5% on the day. And then you take a look at the bond market, maybe finding some safety in the long end of the Treasury curve with yields down about 3 basis points. Much more coming up. This is Bloomberg. In today's ETF Friday, we're taking a deep dive into how First Trust, it's a quiet financial services company, it lured billions to its ETF empire with some creative sales tactics. Emily Gruffeo spent a long time reporting out the story. I am thrilled to say that she joins us now. So Emily, over at the ETF desk on the Bloomberg News side of the building, we often talk about how ETFs are sold. They're not bought. And First Trust certainly was selling its ETFs.
Yeah, that's right. I mean, they were kind of known in the industry for their selling of the ETFs. They connect with financial advisors instead of marketing directly to retail. What our reporting shows, though, is that using internal emails that we uncovered through this process, I worked on the story with Max Abelson, there were some instances where First Trust has pushed up against industry lines when it comes to how you can actually sell these ETFs, and in some cases arguably crossed the lines. FINRA essentially says, you know, you can't promise something in exchange for a sale. You can't say, you know, you do this, I'll take you on this vacation if you do this sale with me, for example. And you also can't have dining and entertainment that is too frequent or expensive enough to raise any question of propriety. So that's a little bit of a gray area. Like, what exactly is too frequent? What exactly is too extensive?
Right. So the story kicks off with a line that really hit home for me. From this guy, this salesman, Jim Bowen.
This hit home for me, too. It was a great quote.
So he's talking about financial advisors, the nobility of what they do, and saying, you know, they spend their entire life tending to the wealth of others. And that's how I think of my financial advisor. I'm like, man, this guy is doing me a real solid.
Yeah.
But then I realized he is also always trying to sell me, you know, a slate of products that he has. This is what they do, right? This is not specific to First Trust. It's just how the industry works.
Right. But what we do know, and what is different about First Trust, is that when you look at the data and the estimated revenues, First Trust makes almost as much revenue, at least according to BI estimates, as Vanguard. But they're about 15 times smaller. So that anomaly, we know, makes First Trust stand out. And FINRA is looking into First Trust's sales practices. So that investigation is still ongoing. So we don't know how it will end. But as far as I know, there's not other major ETF companies where FINRA is investigating.
And you have some great quotes in here. Again, a deeply reported piece. It's just a joy to read. One of these quotes is from a wholesaler who worked with First Trust from 2011 to 2020. And he said to you, you're selling the most expensive ETF with mediocre performance. You better do something different. And that's what we did. So you mentioned that we're talking about a company that's much smaller than Vanguard. But when you take a look at their lineup, I mean, what kind of products are they actually selling? And what kind of costs are we talking here?
So they have a lineup of buffer ETFs, which is kind of a space that they really dominate in.
Magical ETFs.
Exactly. Those are more expensive, but you would expect those to be more expensive. But they're still relatively more expensive than the other buffer ETFs. But some of their biggest ETFs are index funds. There's a dividend index fund. Now, it is an enhanced index, but it's about 60 basis points. So every category of funds that they had, our reporting showed that every single fund was more expensive than the competitors' funds.
To Matt's point, you know, on one hand, there were some very specific examples of here, and, you know, I'd love for you to kind of name some of them, because part of this is activity in the industry that we see other places that, to your point, toes the line between the relationship between these companies and the FAs that then meet the clients. What was First Trust doing that was particularly extravagant, let's say?
I definitely don't want to spoil the whole story. I want everyone to go out and read it. But in terms of specific examples, you know, we uncovered one internal email where a managing director was telling the, you know, his employees essentially, we have wholesalers repeatedly saying, you know, if you do this business, I'll get you on this trip to Chicago. They were known for sales forums where they would take the advisors out and they would pay for the flights and the hotels to go and sell these ETFs. So read the story, you'll see these specific examples of crossing the line.
Great reporting by Emily Gruffeo. Go check out that story. In the meantime, we do want to bring you some breaking news, and that is that Putin is said to be ready to agree to a Ukraine truce with conditions. This news just coming in the last couple of minutes, of course, suggesting that maybe there's some progress towards a final peace settlement, but working through the details right now. But that headline, once again, Putin said to be ready to agree to a Ukraine truce with conditions.
Some more details here. This would be a temporary truce, provided progress towards a final peace settlement, which could lead to a lot of headlines over the weekend. This is, of course, a Friday, and these weekends have been very volatile.
Right. I mean, we should point out that our reporting shows this first positive sign from Vladimir Putin was conveyed at last month's talks in Saudi Arabia between top Russian and American officials. We were reporting on those. So this isn't new news from in terms of, it's not like Putin said this morning, okay, I'm ready.
What is new is that the U.S. and Ukraine do plan to meet in Saudi Arabia next week for direct talks. And so this, to your point, not so new news around potential ceasefire.
Well, it's interesting to see that because we're 1 week out from that extremely tense Oval Office fight, if you want to go that far, between J.D. Vance, Donald Trump, and the Ukrainian president as well. Now, like you mentioned, Shonali, we do have new details that there is a plan for the U.S. and Ukraine to meet in Saudi Arabia. And of course, this comes minutes before the president is scheduled to speak. We don't have details exactly on what the topic is. Could be the jobs report, it could be this news, but plenty of things to discuss.
Certainly, the rest of the day is shaping up already to be a heavy one on the news headlines.
Yeah, but hopefully it'll chill out after that because it's Friday, and we hope you have a fantastic weekend. Obviously, you want to stay tuned for the rest of the news day. Donald Trump coming up at 11, and then Jay Powell coming up with his views on the U.S. economy at 12:30. This is Bloomberg.
From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York, I'm Caroline Hyde.
And I'm Jackie Davalos in Washington. This is Bloomberg Technology.
Coming up, crypto leaders flock to D.C. for the White House's Crypto Summit. This as Trump signs his Bitcoin Reserve Executive Order. White House AI and crypto czar David Sachs joins us to discuss. Plus, AI spending still going strong. Broadcom shares rise after the company gave an upbeat forecast, with AI demand a key driver in its first quarter. And HPE also out with earnings, but they send shares tumbling as profits erode, in part due to tariffs. We speak with the CEO, Antonio Neri. But first, breaking news but moments ago, Russia is willing to discuss a potential truce with Ukraine, but it is with conditions. Willing to discuss a temporary truce if there is progress towards a final peace settlement. Let's get straight out to Kayleigh Lyons. What's the nuance here?
Well, Caroline, Bloomberg did just break this story, citing sources familiar with the matter, but I would point out that this is something that Russia apparently presented to the U.S. at talks in Saudi Arabia that happened last month. A suggestion that, yes, they are willing to agree to a temporary truce, provided that there is an effort toward a peace deal that Russia likes. Specifically, what Russia has asked the United States is clear guidance on what the parameters of peace would look like, specifically what a peacekeeping mission in Ukraine would constitute, as Russia has rejected the presence of NATO troops on Ukrainian soil. That would be complicating for the idea that France and UK, for example, would be providing troops for that peacekeeping mission, the so-called coalition of the willing we have heard European leaders talking about in recent weeks. Russia does not like that idea. They would, though, be open to a country like China providing a peacekeeping force, though it's unclear whether or not that is something Ukraine would agree to. We should keep in mind that this news is breaking as we are expecting next week senior U.S. officials, including the Secretary of State Marco Rubio, the National Security Advisor Mike Waltz, as well as Special Envoy Steve Witkoff, to be meeting with their Ukrainian counterparts in Saudi Arabia for additional talks toward peace, as the U.S. is still continuing to push for a deal.
Kayleigh Lyons with a wrap. We thank you. Let's just take a quick look at the markets in reaction to this. They do bounce off of their lows. Nevertheless, we are having a torrid time in the Nasdaq 100. At one point hitting correction territory, we are down more than 10% from previous highs. This is, we see 3 straight weeks of declines for the tech benchmark, the longest losing streak since August. We're off by more than 4% over the last 5 trading days. And this as anxiety grows regarding Chinese AI models, what that means for compute demand, what it means overall for be selling your winners into a economy that could potentially be slowing on the back of tariffs. Move on to what's happening in the world of crypto, though, because so much to delve into when it comes to the latest executive order. We're off by 1.8% on the day. We're at 88,000, but remember, we're still well higher than the $67,000 level we were at when the presidential election occurred. All of this as many anticipate that such regulations will become more pro-crypto, and we see that executive order signed last night with a reserve for Bitcoin. We're now pleased to be welcoming to our TV and radio audiences around the world someone who can dive into this exact executive order. We bring in the White House AI and crypto czar, David Sachs. It's busy. You're about to expect yet more people coming to the White House from the crypto sphere. Remind the American public and investors why you need a Bitcoin reserve at all.
Well, good to be here. I mean, the reason why we need a Bitcoin reserve is that the federal government already owns some. In fact, it obtained around 400,000 Bitcoin over the past decade through criminal and civil forfeitures and seizures. And so the government has to have a strategy for how it deals with this. In the past, the strategy has been simply to sell it, in an ad hoc way, almost willy-nilly. And that cost American taxpayers something like $17 billion in lost value. So we want to have a long-term strategy to maximize the value of these holdings. And we've decided that Bitcoin is scarce, it's valuable, and that it's strategic for the United States to hold on to this as a long-term reserve asset. So that's the plan with the 200,000 Bitcoin that we believe are in the possession of the federal government. And I say we believe because no one really knows for sure because we never had a proper audit. So that's one of the first things that this executive order provides, that we're going to do a full government-wide audit to find out what digital assets we actually have so they can be safeguarded and moved into a strategy that maximizes their long-term value.
Right. And then there's the stockpile. Talk to us about the nuance there and why you need a stockpile for altcoins and how you're treating them differently.
Right. Well, the idea there is, again, we're going to figure out what do we actually have on the federal balance sheet, and we're going to move those, like you said, altcoins or digital assets other than Bitcoin into a stockpile for safekeeping. The difference there is that the Secretary of the Treasury will exercise responsible stewardship over those assets, and he has the discretion to rebalance the portfolio or to sell items in that portfolio. But that's not true for Bitcoin. The Bitcoin we want to keep long-term. So there's a difference there in objective. With the reserve, the goal is long-term preservation. With the stockpile, the goal is responsible stewardship, portfolio management in essence.
David, the executive order also tasks Secretary Lutnick and Bessent with finding budget-neutral ways that won't cost the taxpayer to add to that reserve. What qualifies as budget-neutral? Can you give us some examples of how that would actually work?
Well, budget neutral just means it won't cost the taxpayer anything. It won't increase the deficit. It won't increase the debt. So that's basically the constraints on what they can do. If they can figure out creative ways to add to the stock, to the reserve of Bitcoin, they're allowed to accumulate more Bitcoin. But again, it cannot impose any burden on the federal deficit, debt, or the taxpayer. So that's the rule. Now, you can ask the question, well, how are they going to do that? And I think that's sort of up to them. If they can figure out creative strategies that they believe are in the long-term interest of the country, they now have the authorization to develop those strategies.
Do you think using savings that come from Doge, for example, qualify as something that would be budget neutral?
That's a good question. I don't know the answer to that question. I think that that's something that have to be assessed by probably the Office of Management and Budget. I think that since Doge is cutting the deficit, and we'd want to seek a way to rescind those appropriations, it probably would not count. But you probably have to ask the OMB that.
When you talk about the stewardship, particularly the stockpile, could you be seeing things like staking, lending? Is there going to be other ways to maximize the volume there?
I mean, it's a good question. I mean, I think that the idea of this executive order is to create the mandate, right? So first of all, we're going to move these digital assets from wherever they are all over the government. We're going to find out what they are. First of all, we're going to do the accounting. We're going to do the audit. Then we're going to move them into a separate account for safekeeping. And then the Secretary of the Treasury and his team will be able to exercise portfolio management and long-term and responsible stewardship. And yes, that could include staking. It could include rebalancing. It could include sales. These are all options that they can pursue if the Secretary of the Treasury believes that these are in the long-term interests of the American people.
Just going into what's in the holding of the U.S. government, going back to what President Trump mentioned over the weekend, talking of Ripple, Solana, other alternative coins, that people are wondering whether they're going to be included in this stockpile. Will they? Does the U.S. own them? Why mention them by the president?
Well, the president just mentioned the top 5 cryptocurrencies by market cap. So I think people are just reading into this a little bit too much. He just mentioned the top 5. In terms of what we'll actually have, again, we have to do the accounting. We're not sure, sitting here today, whether the federal government owns any of these alternative cryptocurrencies. We know it owns Bitcoin. I believe it owns some Ethereum. I'm not sure about the other ones. This is why we have to do the accounting, is that, to be honest, no one's been able to give us a straight answer yet in terms of what the federal government owns. And this is part of the problem, is that we've never really had a digital asset strategy before. And this is why we've, missed out on accumulating a lot of value for the American people.
David, you mentioned earlier that you don't have any additional cryptocurrency assets anymore. You've divested from your interests there. However, Secretary Lutnick in July mentioned that he had, quote, a shed load of Bitcoin. Do you think it's important for these stewards of the reserve and the stockpile to divest from their cryptocurrency interests? Do you know if they've done so already?
I can't speak to his situation. Every member of the administration has to go through the same ethics process and the same conflict of interest process that I've gone through. So I'll let him speak to his own situation. I can just say that in my case, I divested or sold all the cryptocurrency that I owned prior to the start of the administration. So there's no conflict in my case. I just want to have the right innovation policies for the United States.
Do you think it's important, though, to just not have that appearance of a conflict of interest?
Sure. I mean, look, we're all subject to 18 U.S.C. 208. These are the conflict of interest provisions. Every member of the administration is subject to that. And but I'm not going to speak to anyone's situation. So we all are governed by the same conflict of interest rules. In my case, I chose to just divest everything to make it really simple. You should ask every other member of the administration what their situation is.
How about the president? Because I think herein lies some of the issues for those who are on the outside of crypto looking in and suddenly feel that the US president has an exposure to meme coins or Solana. How do you give the confidence to the US investor base and indeed US population that this is totally legit?
Well, honestly, I think you're kind of making something up there. I mean, how do you know that he has exposure to Solana? Is that something you just came up with?
Well, ultimately, when we think about the meme coin exposure in particular, and people trying to understand for what reason we have a Trump coin or Melania coin, is there a clearer way that the US president can disassociate himself from any upside when it comes to cryptocurrencies?
Well, I think he's already spoke to the Trump coin, and I think that is a collectible. The SEC said it's a collectible. Collectibles have no intrinsic value. They're not securities. They're in a different category. And I think as long as you issue a meme coin and disclaim that there's no intrinsic value, it can just be a collectible. So that is a different category, I think, than what we're talking about here with cryptocurrencies.
What do you make of some of the market reaction? I mean, clearly Bitcoin down earlier today on the back of just not really getting what they were hoping for. You know, if the government is not going to buy additional crypto, then what's really the benefit? But can you say for sure that the administration is not open to using taxpayer dollars in the future? Is that completely off the table?
According to the CEO, it is. We've said that this will not cost taxpayers a dime. So we've been very clear in this executive order that we will not use taxpayer funds to basically accumulate more crypto unless it can be done in a completely budget neutral way. No increase in the deficit, no increase in the debt, no use of taxpayer funds, no burden on the taxpayer. We've been very clear in this executive order about that.
David, let's move on to artificial intelligence, where you're also weighing in on policy there. The Biden executive order was repealed in January. What is in the works currently that you can share about how that's looking and who's involved?
So the president in his week 1 executive order on AI that rescinded the Biden EO, by the way, that was a very burdensome executive order that Biden had passed. It was over 100 pages of burdensome regulations on AI companies. The whole industry hated it. He rescinded that, and he tasked 3 people to basically evaluate and create a new AI action plan. And those people are the head of the Office of Science Technology Policy, the National Security Advisor, and myself. And so we're currently working on that plan. And we'll have more information for you about that once we're ready to present.
David, how confident are you at this moment around AI leadership here in the United States? That thick and fast, the news coming out of China, for example, of the latest models that are incredibly powerful with less data and ultimately more efficient. How are you exercising the view that AI can be still a leader for the United States and not losing its leadership versus China?
Well, I'm confident in American leadership, but we can't be complacent about it. I mean, it's very clear that China is going to be very, very competitive. Something like roughly half of the AI researchers in the world are from China. They are very good at math and science. And you've seen with the launch of DeepSeek that they're very good. They're very good AI software companies. So this is going to be a very competitive race, and we have to win that race. But we can't be complacent about that in any way. It's going to be a very tough competition here.
There's actually reporting from other news sources that maybe DeepSeek would be banned from apps here in the United States. Do you think that's appropriate?
It's premature for me to comment on something like that. If the administration